So to get started, I'm going to ask each of you guys just to do, a quick intro, name who you are, name and face. So if we can kick things off with that, we're going to start with you, Joshua.
Yeah, I'm Joshua Rivera. Excuse me. General Counsel at Blockchain Capital. Joined in May, and I've essentially kind of taken over our tokenized fund in terms of managing it and making sure that it does what it's supposed to do from a regulatory perspective. And I'm sure I'll get into the history of that a little bit.
Absolutely.
I'm Greg Gilman. I'm one of the founders and also the General Counsel of Science, which is a almost 8-year-old incubator and traditional venture fund, as well as a tokenized fund in Santa Monica.
You have seniority here, right? Because you're 8 years and, right?
I think we might, but it's hard to tell. Yeah.
I think you could measure seniority in weeks in this one. I'm Jamie Finn, president and co-founder of Securitize. I'm also sort of in the admin function around the 22X fund, which is a very innovative project we did earlier this year. And I'm also a seed investor in Spice.
Yeah.
There you go.
Yeah, I'm Ami from Spice VC. We're a closed-ended VC fund, which was tokenized from the beginning. We tokenized about a year ago, so just about to open to trade for U.S. investors.
Awesome.
Awesome.
That's excellent.
Yes.
All right, fantastic. So these four guys are really the trailblazers in this space. If you want to be a risk-taking entrepreneur, it doesn't get any better than this. So I want to start with you, Joshua, because we had a good conversation the other day, and you guys are the first.
Yep.
You get to claim first.
We're the first.
Better for worse, you get first. And you could be the biggest. We don't quite know,
Yeah.
Depends. So how did you guys or your team or BCAP decide, let's go create a tokenized VC fund? I mean, you just woke up one day and said, that's it? That's what I got to do? I mean, what's the genesis of this?
Yeah, well, I think we one thing we like to pride ourselves in is being is practicing what we preach, and so this was a really great opportunity for us to look at tokenization, look at blockchain, and implement it into our actual practice. So, Blockchain Capital has been around for 6 years. We've got 4 funds, and the tokenized fund is our third fund. So we had 2 venture capital funds before that, and so we saw a really great opportunity at the beginning of 2017 to make a fund that was tokenized. And I think the idea was that we would be able to participate in the ecosystem and trailblaze this idea of actually using a token to represent a limited partnership interest in a fund. So in April of 2017, we issued our tokens. We raised $10 million in the fund. The fund is between 26 million and 30 million now.
Which is good, right? It's going in the right direction.
Yeah, it's growing. We like to think of it as an opportunity for holders to have access to kind of blue chip crypto assets that would have been difficult to get, or would be difficult to get right now. But our BCAP kind of gives exposure to that in a really diversified way. So it was an opportunity to do that. We're very proud of the fact that we're the first. It has also brought a lot of brain damage with it, as the first things go. It's been a huge learning experience. We're coming up on 2 years now. And I think we're finally starting to get to the place where it's working mostly on its own without too much hand-holding. But we've essentially had to deal with a number of regulatory items that have come up that we've had.
And I want to get to that because I love regulations. I have a DNA flaw. I love regulatory discussions. But so, Ami, you were second. Right, you get to claim second, which is cool too. It's not first, right? But I saw you a while back. You wrote something about how you were doing things differently as opposed to BCAP. So what's the secret sauce into what you're doing?
Yeah, when we started, we were looking for examples of tokenized fund. There was only one. So we looked at what they were doing. And,
You're welcome.
It wasn't a crowded space, right?
No, it was nothing. No, the lawyers didn't know what we were talking about.
They still don't.
Still don't. There was no
Sorry.
infrastructure, no technology. The technology provided that they used was a bit iffy, and we couldn't use them. So basically what we did is we said a few things. First of all, we want to do it differently by just creating a simpler fund. So our fund is just a closed-ended fund. We do an exit, we return the money to investors. That's it. It's not an open-ended fund, because on an open-ended fund, it's harder to measure the value of the token as opposed to our situation where the value of the token is the value of the exits. So we wanted to do it simpler. And I talked to the people, the originators of your fund. They just couldn't find a way to do it legally. They wanted. So we found a way to do it legally, so we improved on that. And then because there was no technology at all, we sat down, we brought in some people like Jamie, which was, by the way, our first investor in the fund. We said we want to build this platform to tokenize. So a platform was built, Jamie joined in, Carlos Domingo started managing it, that became securitized. And that's how we launched Spice on a platform that was more mature than the platform that was originally available to Blockchain Capital and is now available in the market. And we closed the circle when you guys, when Blockchain Capital actually reissued or upgraded their tokens to run on our platform. So now we're on the same level using the same platform. So it's like a way of iterating together on the market and improving the market together.
Okay, excellent. So, I mean, you mentioned Jamie, and we were talking about this a minute ago. Securitize is kind of the glue that's pulling this all together. So that's part of what you're doing right now. And I see your name come up more and more and more, which is really cool for you guys because it means you're executing, you're doing something correctly. But you're also doing fun. First of all, can you share with the audience kind of what the glue of Securitize does? And then I want to talk about your fund.
Sure, yeah. I mean, so essentially at Securitize, we provide a platform to be able to issue digital securities and do everything you need to do with them around the regulatory frameworks that exist in the US and a variety of other markets in terms of trading and secondary market compliance and all the brain damage that was referred to by Josh here. So it's a platform product that we are scaling. We have about 7 tokens issued on now, representing hundreds of millions of dollars in assets on the Ethereum blockchain. And we recently announced we're going to move over and make Tezos available as a follow-on chain. And we've also been working with IBM on Hyperledger and Hyperledger Fabric. So we very much think that as a technology service provider, which is what Securitize is at the end of the day, we need to provide choice to our customers. And so we're always looking to kind of invest and grow that way.
Okay, so tell me about the fund, because
So this fund was probably the most ambitious thing I think I've ever been a part of, and I've been a part of a bunch of innovation. And innovation has one of these wonderful things about it, which people forget. It's like just because you're doing something new doesn't mean you'll do it right, and it doesn't mean it's going to be successful. So 22X Fund was an idea that came together in November of 2017. Most people may remember that as the time when everything was just going up and to the right in crypto, and people thought ICOs were definitely the way to go. So batch 22 of 500 startups got together as a group. It's not associated with 500 startups. It's literally the 22nd batch out of that group all got together and decided they wanted to disrupt VC by raising capital for themselves into a fund that would then distribute it equitably across all of the companies. This is a super ambitious and complex idea because there's 20 plus companies in this fund, and all of them had to agree to any number of different terms on the legal side, but also on the valuation side. So imagine getting 20 people to all agree the valuation of 20 different companies, and these guys were all founders, and it was just a long-form existential debate. Now that said, on the other side, what you get as a product is equity in 20 plus startups out of 500 startups, which is a curated group in Silicon Valley, which is pretty cool. The fund's fully deployed immediately as soon as the tokens were issued. All the companies receive their money, and Securitize in this case, which we will never do again, acts as as the admin and me.
It was a good experience then, right?
It was a very. The good news is I've been through the pain and the drama that our customers go through, and so I can be empathetic. The bad news is it's really hard.
It is really hard. Wow, that's really cool. I can't imagine getting 22 founders to agree on.
You should try doing the NAVs.
Oh my God.
It's nuts.
Yeah, that's impossible. Greg, I don't want to leave you out of the mix here. So you have seniority because you've been around a little bit longer than these other guys here, but you've been doing more traditional incubator-based funds, correct?
That's right.
And you fairly recently launched your Science Inc. fund. Tell me.
Yeah, so we started Science, as I said, about 7.5 years ago at this point, with a $40 million incubator vehicle. We were fortunate enough to have some really successful companies coming out of that incubator, which then gave us the ability to raise a traditional venture fund to run alongside that incubator. We had gotten involved in the blockchain space about 6.5 years ago or so now, including with some of the founding team of what would become Blockchain Capital. And at that point, it was essentially just the Bitcoin space, right? And we built a competitor to Coinbase, and we were running a mining operation out of our office. We made investments in CoinDesk and a bunch of others, but eventually our bank decided that they didn't want to be playing in the space anymore. And when they decided to shut us off, our board decided maybe it was a step too far for us to be building businesses that couldn't have banking relationships. So we shut all those
problem,
businesses
right.
down. It was a challenge, and we shut all those businesses down, which at the time was the right decision, and in retrospect was a horrible destruction of value. But we all became more interested in remaining involved personally, since we couldn't be involved at the incubator level. Fast forward to 2.5 years ago, corresponding with the rise of Ethereum, we said, hey, this has significant implications for the way startups can function at their earliest stages. First, in the way that they can use a native incentive mechanism to solve problems that traditionally took lots of time or lots of cash. Right, so to cold start a marketplace, for example, you could use this native incentive mechanism, which had profound effects for the financing of that startup over time. And the second reason was, it became apparent very quickly that the ability to sell a token might be very disruptive to early stage investing or early stage venture, and we prefer to be the disruptors rather than the disrupted. So we said, okay, we have to jump in and do this. And it was about that time that BCAP was going to market. I think it was that April?
April. Yep.
Yeah. And we met with a couple of the members of the BCAP team, and they said, we just spent a ridiculous amount of money to figure out how to do this legally, and we really would like somebody else that has experience doing this and the risk tolerance / crazy to actually do it. So we sort of learned what they did and spent an inordinate amount of time looking at their offering memorandum. And then, because we went the opposite direction, we decided to make things more complex, right? We said, all right, so you figured out how to make your LPs
right?
liquid at the fund level. I said, I want to make them liquid at the portfolio level. So we created a way to do token distribution from the portfolio companies. If we received tokens from incubating or investing, we would automatically flow 70% of those out to the holders of the Science token, sort of like a dividend, although I can call it a dividend for a variety of regulatory reasons. This is the piece, by the way, in retrospect, I would absolutely not do again, because it's really clever and it was actually fairly simple to do legally, but it's a giant pain in the ass from an administration standpoint. So we've now distributed, I think, 8 or 10 different portfolio company tokens out. And our theory was exactly opposite of being close-ended. We would use the other 30%, sell them in the open market, and use it to replenish the fund so it could be potentially evergreen. And then when and if we had an exit on the equity side, we would use those proceeds to repurchase the Science tokens on the open market. So we would reduce the supply, and then you'd have a smaller supply of Science tokens receiving these future token distributions. In theory, it's fantastic. In practice, it's really a challenge to run something like that. But it gave us $12.5 million was the amount we raised, which traded up during the course of the raise. So it gave us some more capital to invest and build companies at earliest stages in the blockchain space, for which I am very thankful. And we would certainly have done it again, but I might be less ambitious in my target next time. We thought we were going to raise $100+ million, and we raised 12.5. And at the time, it was the hottest asset class in the world. We started our sale in September of 2017. hottest asset class in the world. We were doing it as a security. We were going to the institutional investors that had invested in us directly or in our portfolio companies, and they'd generally done very well. So I was thinking, we're going to sell this out in a day and a half, right? Like, this is going to be fantastic. Well, 3 months later, when we closed the sale and 2 of those institutional investors participated, it was sort of a wake-up call for all of the pieces that were missing in the ecosystem in order for institutional capital to be able to invest and hold these tokens. The most glaring need at the time was in custody, because the conversation sort of went something like, there's no world in which I give you $20 million and you give me an alphanumeric code that you can't replace when I lose it, and you can't even point me in the direction of somebody that can hold it on my behalf.
Yeah, the regulators are uncomfortable with that.
Yeah.
So it was easy. It was a walk in the park, right? It was just
all day.
But I guess that's what you get for wanting to be a disruptor, right?
Absolutely.
You have to close your eyes and run as fast as you can sometimes. I don't know. So one of the things we were talking about a second ago was the fact you had to reissue your token, because it was kind of like, well, in hindsight, I probably should have done that. You're not alone. Right? And I know, Jamie, we talked a little bit about that. Can you share a little bit about, that kind of, like, the light bulb came on, it was dim for a minute, and you're like, oh, shit?
I mean, we've been through the upgrade process, and I was just looking at the panel. I'm grateful because they're my customers sitting to my right and my left.
They're still your customers, too,
and they're still our customers, and we were talking behind them. We're still friendly. The reality is, when you're dealing with upgrade processes and, large amounts of investors all over the world, you have to communicate to them. You have to take them through a process so they can understand. They have to kind of pass a certain series of checks, and it takes some time to explain and get people to really engage with it, because there's also the dubious factor: is this real? I can't. The most popular direct message I get on Telegram from people is this communication a real communication from you? Because they don't. There's so many dubious things that have happened in the past, and now people are getting more comfortable, and it's getting much easier. But this whole upgrade process, for the first kind of pioneers in the space, took a little bit more time. And on our side, was challenging just to, collaborate, because we're a young company. We don't have every process in the world kind of well documented and done. And, we try to figure things out. And so when you're going kind of down the path with your customer at the same time in a new space, you're bound to have a bit of anxiety as you go.
There's a learning curve.
It is definitely a learning curve. Yeah.
And that, we use that term upgrade instead of reissuance, because there's a regulatory reason for that. So when we issued our tokens, we issued under Reg D 506C. That's for U.S. token holders, and then something called Reg S, which is for non-U.S. token holders. When you issue that, there's a clock that runs, and it typically is a year, but it depends on what type of asset your token is. And so in the event of a reissuance, you kind of start that clock over. And that year period is restrictive in terms of what token holders can and can't do with their tokens. And so what we did was not issue a new security. It's all the same security, but we upgraded the mechanism by which the holder has representation of that security. And so that was super important. That was part of kind of the regulatory arbitrage that we worked with Securitize on over the last 12 months in particular. But that's really where Securitize's value has been paramount for us, in having a mechanism where we can go through this upgrade process such that token holders now can be very confident that their tokens are regulatorily compliant, at least in the United States and other major jurisdictions where they hold them.
Well, there's the issue of transference, because if you sell a token to somebody in Europe someplace, they could give it to somebody else, right?
Yep.
And then you don't know how many shareholders you have, maybe in different countries, and that could be a problem.
Yeah, so and that kind of, we ran into that when we first issued our token. Our U.S. token holders were locked up for a year, so we held their tokens. Our non-U.S. holders, we just gave them their tokens. And then things like Ether Delta and Liquidity and these other exchanges or decentralized exchanges became more prominent, and all of a sudden people realized, oh, I can just take my BCAP tokens to Ether Delta or to Liquidity and exchange them with someone else.
Which is really cool, except it could create a problem.
It's great. It's really cool, except the problem is, if you're a Reg S token holder, you can't sell to a U.S. person for at least a year, and because U.S. persons are not supposed to be holding those tokens. There's something called flowback under Reg S that prevents requires the issuer to ensure that the security that they issue will not end up back in the hands of the U.S. person. Otherwise, the exemption from registration that you as the issuer were entitled to, that gets blown. So this
That's
became
not good.
that's not good. So while the proof of concept, via these decentralized exchanges was really excellent, it created this regulatory this problem. It was a big problem, and so. Like Jamie was saying, the process of communicating with token holders in order to get them upgraded tokens is one of the most difficult ones. And blockchain capital is actually willing to invest in a company that can figure out a way to communicate with wallets. So if you have an idea, I would love to talk to you about that. Great, yeah, I'll see you after. But that is one of the most difficult things, because you have these wallets that hold your tokens, and maybe the email address that the token holder signed up with originally is still the one that they're using. Maybe they used a throwaway email address. It's a year later. You have no idea whether that person is still checking emails. Maybe they're off in the Seychelles because they made a lot of money in 2017. Who knows? So that was a huge pain point. But what we have now is we have the ability to issue tokens and make sure that the actual smart contract is programmed such that they can only be transacted among whitelisted wallets. And that
You guys figured that out, or you figured that out? Was it just a partnership?
well, we asked them to figure it out, and then they
And then
did.
you did it.
And, yeah.
Yeah, I mean, and the technology, and there's a few other examples of it out there, but the technology that we put together was really driven by the kind of demands from the issuers, right? So it's not
Right.
Oftentimes, Securitize as a company will receive a bit of criticism because we haven't released our code and made it a standard and things like that. And the problem is, in our experience, we keep having to change it because not all the regulations are super clear.
It's a moving standard.
It's a moving target, right?
Yeah, it
and
doesn't
so
work, yeah.
what's happened, and it'll continue to happen, I'm sure, is there'll be requirements that'll come from different regulators in different countries. You'll have to upgrade one piece of it and change how one component works. And as you do that, doing it through a process which involves committees will never work well. And so we very much follow kind of much more of an internet model of build it, deploy it, get it scaled, and then it can eventually roll out into a broader solution. But I mean, at the end of the day, there is a number of different control mechanisms that have to be in place, and they have to be upgradable because they're not static. And so as you go through the process, that's one of the most important things to figure out.
And this is actually one of the rare occasions where technology is catching up with law rather than the other way around. We all relied on exemptions for issuance that are decades old.
Right.
And when we first did it, the technology didn't exist to enforce the post-sale transfer. So we were all relying on contractual provisions in our offering memorandum. And then eventually Securitize figured out how to make that technologically enforced, which from our collective perspectives was a much better alternative than relying on contractual provisions that most people either didn't care about or claim they didn't read or whatever else. So
It's maybe the closest correlation of smart contract with an actual contract.
yeah.
And there's still nuance I keep discovering.
Right, and that's important. I mean, what's the biggest hurdles you've experienced in the creation of your fund? What are the things that you said, oh my God, what am I doing?
I think that when we came into it, it was moving from the ICO world into the STO world. And ICO is all about retail. So we thought, we'll go retail. Obviously, everyone in the room now knows that for STO, retail is less interesting, especially the crypto retail, because they are not interested in funds. They're interested in crazy stuff that go up and down and all sorts of things like that. So they're not interested in funds. So this focus towards retail, I think in the beginning, was a little bit wrong. And I think everybody understands now that it's all about the institutional investors. Now, in order to go to the institutional investors, you need the infrastructure, you need trust, you need the platforms. And that's exactly, I think, where the market is going now. It's moving from an industry that's more of a blockchain industry into a fintech industry. that those big investors can come in and put in checks of $5 million each rather than $500,000 or $50,000 or $5,000 each. And you don't have to chase after some person's passport, but you're dealing with significant people. I think that's where the market is going. So that's the first thing. The second thing I would say was that when we launched, we led with the facts that we're tokenized. So we say, oh, we are a tokenized fund. This is amazing.
Well, you sold me on that one.
Okay. And you have you have securitized now. Everybody's happy. But that was the original position, and very quickly we started to understand that that is a technical element. It's an add-on. It's a very valuable thing. But what people want to know is what is the asset, and that's exactly going to the first point of going to institutional investors. They care less about the technology and about the liquidity, which still doesn't exist, so it's less of an issue, but they want to know what is your portfolio, what is your investment strategy. And I think that we're moving into, at least trying to move into a world where the fact you're tokenized is just, you're digital and the other people are not digital, and you have a lot of advantages based on that, but the asset is the core. And that's something that wasn't, because we were pioneers, we had to learn this the hard way.
Yeah, and so each of you, I didn't look at your portfolio. You guys are doing mainly blockchain-based companies, right? But some of you are doing crypto-focused companies.
We actually, even more, we doubled down on the security token world. First, we built the SPICE as a tokenized fund, and then we sat down and realized, hey, this is not just about funds. And when we announced Securitize, all of a sudden, all sorts of assets came, and very few of them were funds. They were all sorts of assets. So we doubled down, and pretty much all of our investments are around the infrastructure for security tokens. So we're investing in exchanges in various places, in issuing platforms, in investment banking solutions, all sorts of technology, security, stable coins, everything around making this industry grow, because we think if it grows, everyone in this room building technology, if they can cross the gap until this market explodes, there will be big companies.
It's an opportunity right now.
Yeah.
What about you, Jamie? Is everything, protocols and crypto?
No, Batch 22 is actually it's a group of startups selected by 500 startups, so it's all over the place. I mean, there are some payment companies. There's one crypto company in it, but for the most part, there's a company solving vaccinations in Africa, so it's literally all over the place in the fund.
Yeah, and I think that's an important distinction is as this entire industry evolves, it's really going to kind of spread out across everything. I noticed when I was looking at your site that you have Authy in there, and I'm a user of that since I was SimSwap hacked not too long ago, and I learned my lesson the hard way. But I'm assuming it's the same with you. Is it just blockchain folks?
We have two separate incubators, and we use the proceeds of our tokenized fund to invest solely in the blockchain incubator, which then invests blockchain-related businesses, right? So, or either blockchain directly or blockchain-enabled, or the entire sort of financial ecosystem around it as well. So.
Okay. So do all you guys see that this kind of these early days, the nascent creation of the technology you guys are all building, do you foresee that spreading out into other traditional assets, quite rapidly, real estate, stocks, bonds, and then maybe into non-traditional? Are you one of these, these blockchain maximalists, I guess? Is that where you see this going? It's going to rule the world at some point in the future, or is that tempered a little bit? Is that too much hubris?
I think the potential is really unlimited. I think the way security tokens are going to go is in a way that we're not really anticipating right now. So tokenization of other asset classes is interesting, like we've all done, right? We basically took limited partnership interests, tokenized those to give people a tokenized share of a fund. Tokenized real estate, tokenized equity for an operating company or a startup. Those things are happening, and that is going to be part of the evolution of security tokens. But I think what having tokenization does and having the blockchain does actually allows for really interesting structures. So you could tokenize revenue shares from a particular product arm, and I think that is much more interesting. Or you tokenize dividends from a particular division in a company. You can create some really interesting financial structures. One thing that people don't talk a lot about, starting to get more play, but you can use security tokens as collateral on decentralized lending platforms. So that's something that we should be able to do in the future that really kind of opens up the world of decentralized finance in a way that we hope will allow for things that we're just not contemplating right now. So yeah, we've invested in Harbor and Templum that are doing real estate, and we know of other opportunities that involve other kind of tokenized assets today. But I think in the same way that when the internet was still kind of being understood in terms of how we use an open, decentralized access to data, things like newspapers just kind of PDFing their newspaper and putting it online. Like that's not really
didn't work.
yeah.
No.
Like
I was there. It was bad.
Yeah, but that's like you can do it, and that's part of the evolution of the internet. But that's not really where the value from the internet comes from. And so I think we're going to see a parallel to that, where right now we just conceptualize our world and then we want to tokenize it, which I think will just happen eventually. But I don't think that that's like the goal of security tokens. I think the goal is to actually create these opportunities that are significantly different from how we do securities and how we do derivatives and other decentralized and open finance. I think it's really going to be different from what we see now.
Do you agree?
I do. I think that in general, the creation of new new types of securities that Joshua was just talking about is certainly interesting. I think that one of the other important parts is this sort of fractionalization piece of tokenization. So you can take assets and break them down into essentially infinitely small pieces and still be able to track them, which it just is not practical in the current financial infrastructure. So as more and more assets are tokenized and then fractionalized, it gives the ability for global participation in analog to sort of what happened in the U.S. and in other developed countries as the market evolved with indexing, right? So where smaller investors can now participate in a portfolio of equities or debt or whatever other type of security they wanted to invest in, and the cost of administering those portfolios is, in the traditional markets, fairly low, you can have broad participation in things like 401ks. Those types of investment vehicles are not available to many investors in the world, but fast forward 5 years, where the course of issuance and maintenance of these types of securities on a tokenized basis is actually lower than currently done in the traditional financial markets.
Right.
And I think we'll see a evolution of a number of new products aimed at those that are currently sort of unbanked or underbanked and certainly not participating in the wealth or potential wealth appreciation of a traditional diversified financial portfolio.
Jamie, do you guys agree? You're all on the same page? Any other perspective there?
Yes, I think that on the short and mid-term, I definitely agree. But I just have maybe a longer-term kind of vision that says that today ownership of things is, especially private securities, is very much analog. And what we're doing is digitizing it. And I think that's one of the reasons that Securitize started calling security tokens digital securities instead of security tokens. It's digital securities. That's what it is. And I think there's almost a law of nature that any information that is analog and starts going digital, it will go digital all the way. Nothing that goes digital ever goes back to being analog. And when it goes digital, it changes and it morphs because it becomes much more fluid. Like with music, we used to have vinyl records, and you used to listen to them. So the first iteration of digitization was to do a CD. Okay, it's the same thing. It's just digital, and that's nice, but it's not really digital. It's digital when it starts to spread, like Spotify, and changes everything. The business model.
Can't forget about Napster.
Napster and the business model. Everything changes. So in my view, I think it's very reasonable to expect that 10 years from now, all ownership will be digital, or everything that's not like really legacy, everything new. in
I'm
ownership.
going to hold you
digital.
to that. 10 years from now, I'm going to check. I'm going to write this down.
Yeah, that's going to happen in
Yeah.
10 years. I'm pretty confident on this one. And the question is, what's going to happen in the middle? And we're definitely going to have like a year or
Right.
two now. They're going to be hard, where people are learning that this digital thing actually works. And because there's a lot of risk aversion. This is property. This is very, very important to people. You can't take any risk, especially the beginner investors. So it'll be a year or two of learning. But then when it starts happening, it will start happening because the advantages are just inherently ingrained. It's better for everybody. It's better for the issuers. It's better for the traders. There's just no downside.
Jamie, you got
Yeah, I mean,
anything to add?
I would just add, I've been through this a couple times, right? And so one of them Ami mentioned, which was kind of internet streaming and music, kind of that whole transformation to digital music. I also went through it at Telco with voice over IP and dealing with that transition from analog circuit switch phone calls to digital phone calls. So, and kind of all the drama that happens in the middle around all these same debates we're having here. So we're definitely seeing this kind of next phase, and it's kind of in its fitful start. We're probably at the Napster phase or Vonage, people like that, very early kind of space. And it'll be interesting to look back in 10 years' time, which is probably where we'll be looking back and say, oh, this is how it started. You remember that company, remember this company doing that. And then some of it will seem wonky and weird, but all of it will lead to a much better place for the issuers and the investors.
Okay, cool. So one of the things that, so the ICO space was a hell of a party, but the hangover was even worse, right? And it was really driven by speculation and huge amounts of unregulated liquidity, which can be a lot of fun if you're on the right side of the trade. So we were talking a little bit a while ago about liquidity, and when I was talking to you the other day, I was asking you, so are you trading? You're trading on Shares Post and
Open Finance.
Open Finance, and you told me the volume, and I was like, that's not bad.
Yeah.
So how is liquidity going for your fund?
Yeah, liquidity is an interesting perspective. I think the appeal of a tokenized security or digital asset is the opportunity for liquidity because the piece that you hold is so easily tradable. Our liquidity, I think, is in the kind of low double-digit thousands, which is pretty good.
Compare that to OTC markets, that's not bad,
Yeah, it's not.
If you actually
Something's
compare
on-
real volumes, which we did recently, on a number of crypto markets, it's actually not bad either.
Yeah, that's
real
also true.
volume.
Real volumes, not
Yeah.
the fake volumes?
Yeah, yeah. So it's interesting. But I also think liquidity, tokenization does not breed liquidity. It only facilitates liquidity if there is a desire, or a demand for liquidity to be there. So, I think there's a bit of a misperception that just because you tokenize an asset, then you're going to have liquidity in it. And so, like, your asset has to be a good asset, or an asset that is well suited to being tokenized, or that people will want to, invest in and trade in. And I think venture funds is kind of, that's patient zero for it. But I don't think we're going to see the most liquidity from tokenized venture funds in the space. I think other assets will be much more will have more of an opportunity to be the kind of the poster children for liquidity in the digital space. It's there, and I think as a proof of concept, we've definitely been able to bear that out. So that's where it's really exciting. We're hopeful that it will only increase as we continue to iterate, as Ami was saying. And the other thing that is important is thinking about disclosure and kind of giving as much information transparency to the token holders and prospective token holders. That's something that is still kind of in the works in terms of how you can do that in a way that is appropriate, that doesn't expose you to significant liability or regulatory concerns. So we're still kind of trying to work that out. But ideally, with more information, more transparency, there should be more liquidity as well.
Are you other guys, are you doing, providing liquidity on Shares Post or Open Finance?
We are on Open Finance. We actually launched early on Open Finance, and we were seeing similar things. That,
Okay.
thousands of dollars worth of trade all the time, and trading nicely around the NAV. So I think some of the problem is that same as you, we're a small fund. People invested just a year ago. Fund is looking great, so there's not a lot of supply. And I think if somebody wanted to sell, they will find buyers because demand is there when people actually present those tokens to be sold around the NAV. If somebody wants to sell like 3 times, they have to wait for buyers. But if you're trying to sell around the NAV, you can find buyers. And I think that tradability itself is something that on its own didn't exist before.
Yeah.
If you wanted to sell your shares as an LP, you have to either sell the whole thing or sell at a huge discount. And that we're already proving that it's there, it's done. Yeah. Now, if you can multiply that, and if Sequoia was tokenized, I'm sure it would have much more trade. It will probably trade above NAV. If our example is trading around NAV, they'll probably trade above.
Right. Yeah, and so I want to jump back to one of my favorite topics, the regulations side of thing and RegTech, because there's a huge opportunity here for RegTech, which should make any decent regulator get all excited. And I know that you guys have ongoing communications with the SEC because everybody's substantial. That's what you do. You go talk to them. They wink and nod, and you listen. But I was thinking when we were having the conversation the other day, for any of the older people in the room, remember long-term capital management and how the sky almost fell and the Fed had to pull a bunch of banks together to save the world because nobody really fully understood the counterparty risk. Yep. But if you think about it, the ability to have this profound transparency on a transactional basis in a world of dark pools of incredibly cool and creative derivative products, this can really help solve that. And I think that's a very powerful element of this, which isn't necessarily very sexy, but it really adds additional legs and runway to what you guys are trying to do. I don't know if you can share any more insight as to what you guys are seeing when you are talking with regulators, if you want to share any of that.
Well, I think generally all of us on stage, and I don't want to speak for everybody, welcome thoughtful regulation.
Absolutely.
Right? We're the folks that tried to do a digital asset offering in a legally compliant fashion first, right? So at least from my perspective, we are more than willing to see this type of thoughtful regulation. We saw the SEC finally come out last week and start to give some guidance that tells potential issuers what they should be doing and sort of where the guardrails are, rather than have, as happened many times in 2017, teams just completely outside the realms of reality and certainly outside the regulatory boundaries, making promises that they could never hope to fulfill and products that they would never come close to shipping, but taking advantage of the desire by individual retail investors who don't get exposure to early stage deals in a Silicon Valley type way, taking advantage of that desire to invest and then raising enormous amounts of capital with no board oversight and essentially zero investor visibility into what was actually happening at those companies. So I, for one, certainly welcome that type of thoughtful regulation that ultimately will engender long-term confidence in this as an asset class, rather than having it treated as the red-headed stepchild that's over in the corner that all serious investors avoid at all costs.
Well, and I do think the regulators have the crypto industry is so broad, and security tokens or digital assets, it's kind of one piece of the broader industry, and so they kind of are pulled in different directions. From the conversations we have from them, they are. This is kind of the one place where they can stand up and say, yes, we want you to continue iterating and innovating in this space, because security tokens are the technology and all the infrastructure that goes up around it, and as analog continues to digitize, as Ami was saying, that's going to make that's going to revolutionize a regulator's job. They're going to have transparency and visibility into who holds what. And kind of control in that space like they've never had before in the capital markets. So I think it's particularly advantageous to them. They just have to weigh that kind of boon for them and the hope that comes with it, which with kind of the rest of the industry that they're kind of not sold on quite yet. So
not quite yet, but someday. All right, we're out of time. If everybody give a big round of applause to our excellent panel. Thank you very much.